the best stress test that we've seen is, going through COVID when we were market leaders in collections. Throughout COVID, we were in the high 90%, 99, 98% throughout, which outpaced our peers, and I think is a good indication of the strength of our portfolio and how it could perform if we do see a recession.
Joining me today is Jason Fox, CEO of WP Carey. Higher inflation and concerns over the potential for the economy to tip into recession are currently top of mind for investors. How is WP Carey positioned for the current environment?
WP Carey offers a unique combination of both growth and downside protection. In addition to our typical growth through external acquisitions, we also offer a really interesting embedded growth within our portfolio. 99% of our leases have rent increases. Of that, 58% are tied to inflation, and within that category, 38 of the 58 is linked to uncapped CPI. So we really expect to see meaningful upside in our portfolio, tailwinds from inflation that'll outpace all of our peers typically. That should lead to record same-store growth to us in 2022. We've talked about greater than 3%, which is typically probably twice what we've had historically, and probably 3 times what we see within our peer group. And 2023, given the lag of how inflation flows through, we should see even more upside, perhaps above 4% same-store growth, which is going to be, again, significantly higher than our peers and really provide an earnings tailwind for us. When you think about recession, and we do know that investors have some concerns there, we offer meaningful downside protection, mainly through diversification, where no one tenant or industry has an oversized impact on our earnings growth. We also really focus on our quality of underwriting. It's something that's been honed over our 50-year history, focused on tenant credit, on structuring with master leases and critical operating assets, that really provides a lot of downside protection when we see economic slowdowns.
WP Carey remains one of the most diversified net lease REITs. Please talk about that approach and whether there are any areas you're currently more focused on than others.
We've been overweighting industrial, which includes both manufacturing and logistics assets, which currently makes up about 50% of our portfolio. And within the industrial category, we've really had some success in acquiring, properties like lab, R&D, food processing, production, that tend to be critical operating assets to tenants. They tend to be on long leases that tenants are willing to sign, given the amount of investment they've made into these properties, and they tend to be, quite sticky. We also are focused on essential retail, mainly in Europe at this point in time, where we think the fundamentals are stronger, more barriers to new construction, higher green space requirements, and meaningfully lower supply, relative to the population size. So that's been mainly focused, I would say, on grocery and do-it-yourself retail. There's also a lot less competition, so we see better spread opportunities in Europe as well. But more recently, we have been exploring U.S. retail as a potential new vertical for us. It's a big market. We know that that's the space that has been crowded, but we think there's opportunities for us to find some good growth paths there. And of course, we have our existing portfolio, which helps us grow. It's a large base of assets, and we have a history of expanding and doing follow-on transactions within our portfolio.
Your merger with CPA 18 is scheduled to close soon. Would you please remind us of the benefits of the merger for WP Carey?
Benefits include it's a portfolio that we know extremely well, one that is very consistent with our existing portfolio, and there's really no integration risks whatsoever. We do think that there is real upside, particularly embedded in the self-storage portfolio that we're acquiring, which is a large portion of this, and we view that as the potential gem of this transaction. With regards to the balance sheet, there's really no impact at all. Post-merger, we would see our metrics look very similar to how they have. We do expect the transaction to be accretive to our real estate AFFO by around 2%, which is largely going to offset any of the IM fees, which are lower quality and are lower valued, the roll down of those fees. It also helps with simplification of our business. The IM segment is something that we've, for the last 5 or 6 years, have announced that it would roll off over time, and this is really the completion of that simplification process, which we know is important. And then, as I mentioned, we think there's upside, both in the self-storage as well as opportunities to refinance out more expensive mortgage debt. So we think there could be some more growth embedded in this portfolio. The transaction's on schedule. We expect a shareholder vote at the end of July from the CP18 shareholders. WP Carey is not required. We don't need a shareholder vote for WP Carey. And closing of early August.